welcome back to the Don and Gino Real Estate and Finance Show right here in your hometown station, AM 1220 KHTS.
And remember, our goal is always to guide you to personal and financial wellness.
We always say this is the best segment because it's our last segment of the Don and Gino Real Estate and Finance Show this Saturday, where you can come Saturday 9 a.m. to 10 a.m. and get educated on what's really happening in the real estate and financial markets. Today was all about education. We brought in Richard Murphy, who is a national trainer, basically salesperson like us in the mortgage industry, author, speaker, you name it, who's helping us give the opinion on what's happening in the economy, because you're hearing a lot about the potential of another recession, and it could be 3 times greater than the last one. And
it's all sensational.
Yeah, listen to the previous shows. Again, go to donandgino.com. All our shows are, we put them on YouTube, and you can watch them. And we talk about how we don't believe that's possible. We don't know why. We explain what happened with the previous recession and why this one's not, we don't feel it's going to be as bad, and actually not a bad thing.
Right. So let's clarify that there is going to be a recession. We don't think the mortgage market is going to be the catalyst for it. And, that's one of the things that, last time, we were the catalyst or the accelerant to that recession. And, you said job loss and then mortgage meltdown. So other recessions in the past haven't been catastrophic. In fact, what happened is a 50-year event. What we just saw was the only other time it ever happened was the Great Depression.
Right.
So the likelihood of the next recession being that bad is it's minimal. It's almost insignificant. Almost couldn't even happen. At least it's not likely. Let's put it that way. Do you agree with that, Richard?
Absolutely. And I think, Don, you alluded to it earlier. Prior to the meltdown of '07, the Great Recession, whatever you want to call it, it was stated income, 100% financing, and you didn't need a very high FICO score to get it. Then qualified mortgages, QM, came into play, where if you're buying the $400,000 home, I got to see your tax returns. What a crazy idea. Gee, if I'm going to give you 400 grand, I should probably make sure you can afford to pay me back. And so that was qualified mortgages. That is single-handedly why the next recession isn't going to be as bad, because yes, values are going to come down, but whereas before, when Bob and Betty bought a house for $300,000, then it was worth $200,000, they walked away from it. They didn't have any skin in the game because it was 100% financing.
Right.
Now with qualified mortgages, let's say that same $300,000 house drops to $270,000, even as low as $250,000. Then we know that they can still qualify for the payment. The payment hasn't gone up 50%, whereas that's what happened to a lot of people before. So based on that alone, it's the only thing I do like about the Dodd-Frank Act is ability to repay. That alone will prevent us from having a major catastrophic meltdown. It's not going to happen.
Yeah, I totally agree with that. And so I don't want to forget to talk about free money, because for years I've been saying that the money's for free, and people believe me at 3%, 4%. They're like, yeah, absolutely, the money's for free.
Gino,
hey,
they're lining up outside the door of Finance America right here.
Well, I was going to say that's why this segment is the best segment, because we're talking about free money. That's why.
Nice.
But explain that so that everybody understands the concept of free money and why we're saying that mortgage money is free.
Sure. Banks lend money to each other overnight. That's the Fed rate. That's the interest rate that they're charging each other for billions of dollars overnight. So if we're talking about cash or investments provided in the form of handouts, which is typically what people think of as free money, subsidies, things like that, if we're at 8%, you think about the Fed rate, it going up, how it feeds into the other Treasury yields, then at about 8 to 9%, if I give Gino $100,000 and I say, hey, Gino, pay me back at 7.5% interest rate, holy smoke, 7.5%, I thought rates were around 4.25%. Well, it's still free money. And Gino says, what are you talking about? Free 7.5% doesn't feel like free money. Well, in fact, it is, because when I, as a bank, if you give me $1 in a deposit, in the form of a deposit checking account, for example, I'm going to lend that money out. It used to be, 30 times, you guys, 32 times. Now it's down to 15. Okay, so 15 times. I, as the bank, take that dollar and it becomes $15. Good for me. Bob and Betty borrower don't understand that. And so in the circulation of cash in our economy, if I give them anything at anything below 8%, in fact, the bank is still making money. Bob and Betty are really not paying very much when it comes down to the true use of that lending vehicle for the home, because they don't have $300,000 cash to buy the house. They've got to get a loan. When you get a loan that's at 8 or lower in terms of interest rate, for them, when it comes down to tax returns, use of cash, cost of cash, like when you have a line of credit, there's a cost of using that money with the warehouse line. I don't know if I'm explaining this clearly.
Well, I just want to make sure we get down to the basics. The reason I say that it's free money is, let's say, even though the Fed says you've got 3% inflation, that's not real, right? That's the bag of goods that they're looking at. Real inflation in our lives is probably closer to 5%, right?
Yeah.
Health insurance goes up, water bottles go up, all kinds of stuff goes up. And so if you have real inflation of 5% and you're borrowing money at 6%, just the fact that your dollar is going to inflate and your mortgage is going to stay the same, automatically with inflation, you erode the cost of money over time.
Yeah.
And so because most people are taking 30-year fixed mortgages, it's a hedge against inflation. So as you continue to inflate, your dollar is worth less, but your payment stays the same. So you're eventually, it's going to be very easy to make that payment. And that's why you look back on, people that have had mortgages for 15, 20 years, they're like, oh, my payment's like $1,400 a month. You're like, how do you pay $1,400 a month on a $700,000 house? Well, it's because they borrowed very little, and so inflation for me is why I say it's free money, because and you got to subtract the tax benefit.
Well, you got tax benefit. That's what I was to say. You add that in, and between the two, it's the best way to leverage money there is. Period. I mean, that's why we're we always talk about the net worth of those who own homes versus those who don't, and those who own homes have a net worth 46 times greater than someone who doesn't own a home. It's the best way to gain net worth, period. I mean, I don't know about you, but if you have a $300,000 house that's going up 5% a year, and you're making $15,000 a year,
and you only maybe put $10,000 down, so you've doubled your money, right? So that's the other thing to take advantage is there's no better vehicle that gives you massive leverage than a house.
Right.
So you're putting in very little of your own money. Potentially, you could do whatever you want, but most people are putting in very little. We're doing a lot of mortgages at 5% down. A lot. Most young people are buying homes with 5% down.
Right. That and FHA are the two most popular. Of course, non-qualified mortgages, stated income, interest only, those never really went away. Nobody was buying them on the street. So we get through what we've gone through over the last 12 years. Stated income, interest only, they're back in full swing, and those loan programs have spiked in use 90% over the last 12 months because housing values were going up, rates were going up, people couldn't afford a house, or if they could, they thought rates should be at 3% forever, and that's just not realistic. But now with the stated income loan, you can't do it at 100% financing anymore.
No,
you got
30% down.
Right, at least 25, 30% is probably more the norm, and you can't just take a picture of yourself, take a selfie next to a landscaping truck, and it might not have even been my own truck, and say, look, I'm self-employed, or go down to Kinko's and print out a business card. Look, I'm self-employed. That used to work before. Now you got to get a letter from the CPA. You got to show tax returns.
Verifications of the business being in for, around for at least 2 years and so forth.
Right. And so those are even further indications as to why we're not going to have this great big scary meltdown, because we're not selling ratings. We're here to help people buy homes or sell homes and educate them.
Yeah. All right, I like you, Richard. You're all right.
Thanks, man. I appreciate that. And forgive me, guys. You were talking about free money as it relates to the borrower, and I went out into left field talking about banking and the banks and overnight. I went down the wrong rabbit path. Forgive me.
No, it's okay. Actually, it's free money for them as well, and that's kind of what keeps our economy moving. Let's be honest. Is that multiplier is what allows our banking system to flush cash into the system, and we don't have time for this conversation today. But what creates inflation is not money supply; it's the velocity at which it changes hands. And because they printed all this money, and you have all this money supply, and you said, "Oh, we're going to have all this massive inflation." Well, if the money doesn't move, then there's no inflation. But now it's starting to move, and that's why the Fed's bringing up the.
And that's a good sign when the Fed raises interest, as we talked about. We'll end with this. Rates going up means the economy is strong and they're trying to cool it so we don't have inflation. So don't panic. Interest rates going up meaning you're more comfortable that you're going to keep your job. You're more comfortable that you're going to get a pay raise. You're more comfortable that your house is going to go up in value. These are good things. This is a normal economy that we all should enjoy and not be afraid of. So, Richard, thank you very much for helping educate our listeners, our real estate professionals, our borrowers. Great stuff. I really appreciate you being on the show.
Absolutely, my pleasure. Thank you for having me, guys.
All right. Again, Richard Murphy, if you ever want to, what's a good way to contact you if anybody want to contact you for more information?
You can hit me up. I post a market commentary on LinkedIn and Facebook every day. You can catch me on either of those two platforms. You can shoot me an email. I'm pretty easy to find.
All right. Again, thank you very much, and happy holidays, Richard. And again, happy holidays to all of you out there. Have a great holiday weekend. We appreciate you being part of the Don and Gino Real Estate and Finance Show. Find out more at donandgino.com.